Morning traders and investors. My name is Roger Scott and I'm the senior strategist for 𝗧𝗴𝗀. Welcome to the midweek roundtable. We have our usual co-host, 𝗧𝗴𝗀. This is a time where Jeff and I get together and we just shoot the breeze about what's happening in the market. It's not scripted. We don't have any agenda. We simply want you guys to pay attention to how we think about the markets. Now, Jeff is the senior trader and the head trader of Joy of the Trade. If you want to reach out to Jeff, very, very simple. Jeff at joyofthetrade.com, or you could visit Joy of the Trade, or you can always find Jeff and Jeff's products and services on the 𝗧𝗴𝗀 website. So please go there and check out 𝗧𝗴𝗀. You will be very, very pleased with what Jeff has in store. And Jeff has things. Jeff's been talking about this China debacle for the last 5-6 months, way before anybody started talking about it. So Jeff has some really good info. You don't want to miss it out. Follow the link. Check out Jeff's info. Jeff, how are you doing this morning?
I'm hanging in there, Roger. Fighting a good fight. How are you?
I'm doing pretty good. I'm sure we're going to have a lot of people tuning in this week because there's a lot going on in the market right now. I mean, this China thing is going crazy. I mean, you and I have been all over it. You've been all over it before it was even, it wasn't even like a blip on anybody's radar. That's your specialty, and I'm really glad we have you on board for that, because it's good to have. Most people don't realize, especially beginners who are starting out, but global markets is by far, and I mean like by far, the biggest influencer on U.S. stocks. Microsoft is not going to cause the same type of rally as China. So, it trickles down like this, folks: global currencies, the bond market, and then stocks. So it's a trickling down effect. Anytime you see anything on the stock market, it usually starts off with the bond market or the currency market. So Jeff, talk to me. What are you seeing? What's going on? What are the threats? What are the opportunity? What should investors and traders be doing right now? We've got a lot to talk about.
Oh my gosh. It's like, where do I even start?
Yeah, where do you start?
First of all, I'd like to address the whole, my knowing about China and stuff. Those of you that don't know at home, Roger knows this already. I spent a good amount of time in Wall Street, but a good amount of time specifically focused on international stocks, trading stocks around the world, not just in the US. Because Asia was, frankly, one of the best places to invest in the early 2000s. So China joined the WTO in 2001, and Chinese stocks, after the Nasdaq bubble collapsed, do you remember this, Roger? Chinese stocks were all the great growth and action was. So from 2001 till about 2008, a lot of investors from the US, a lot of traders from the US started to learn about different countries, specifically Asia and specifically China. Now, what happened was, you had a country that went from being real farmer country to all of a sudden being what is embraced as a capitalist modern economy. So the stocks all flourished. What's happened in the last year and a half was a huge change in the official sentiment from the government in expanding that philosophy of capitalism and embracing international corporations, and they've started attacking their own companies and other international companies. And when I started to see that, I said, wait, hold on a second. At the same time they were doing this, they had this huge, they've been having a huge lag in their natural growth. They hit a plateau in how much their country was growing. China in the early 2000s growing at double digits GDP a year. Now there's a little bit of salt with that. There's a little bit of sugar on top of that. Everybody takes it with a grain of salt. But now you're seeing a China that's growing at south of 6% a year GDP. Could be half of that if we go by real numbers, which they would never let us look at. So you've got a country that's economically stalling at the same time that a government is attacking their best companies because they believe that they're wicked in how they make money. For instance, Alibaba, which is one of the greatest companies in the world, right up there with Amazon in terms of efficiency. They're an online retail company that trades Chinese services for big companies around the world. And Chinese Communist Party came out, 6 months ago and was like, you guys should give us 50% of your profits for the good of society as an ethical thing. Could you imagine if Joe Biden woke up one day and was just like, hey, Tim Cook, get on the phone. You guys are making way too much money. Aside from your normal corporate tax rate, I think you should donate 50%, like the mafia almost. I think you should donate 50% of your income It's back to us to take care of everybody.
It is like the mafia. It's not similar. It is like the mafia.
Yeah.
It's
So then
exactly
what
like
happened? The last leg that just fell was this Evergrande, which is this huge property developer in China. They built cities that nobody ever moved into, and they borrowed a lot of money to do it. They got in a situation like US 2008 with real estate, where the banks had all this bad paper, this bad debt, big hole in their books. Sorry if I'm being long-winded here. I just want
no, please. It's all good. We
severity of the problem.
This is important.
So, yeah, and so that happened in China at the same time as the economy's cooling off. Remember, this real estate company can't sell any condos or office buildings that they built in cities they were expecting people to move from farms into. Never happened. And so China has this big problem because a lot of the people that own these bonds in Evergrande are their own citizens that are getting no yield. They're not getting the coupon, the income that they were promised. Problem is that you can look at it and say, well, it's a $200 billion thing. That's not that big. But what it's emblematic of, what it's giving you a sneak peek of, is the corrosion underneath the hood that's actually happened in that country.
Right.
Now, so how does that impact the US? The big real risk for the US is that philosophical shift with the Communist Chinese Party, that they see their own domestic economy tanking, and they, being kind of like the erratic psychos I think they are, go, we're taking you all down with us. You can't make iPhones and sell them here anymore. You can't sell you can't sell Windows platforms. We don't want it. We're going to create our own. They could do things like that. So I'm worried about what they philosophically have shifted to and what that means for companies that are frankly over levered to how much money they make in China.
Right. And you bring up a very, very good point. Well, you've brought up actually several points.
Sorry to be so long-winded.
No. No, it's all good. I just want to kind of separate the two topics because you've kind of combined two topics, and you did great, and I couldn't agree with you more. I just want to separate the two topics for the readers at home, and then I want to tackle one at a time. Yeah. So the one major issue is obviously this Evergrande. It sounds like a Latin company, Evergrande. It's a Chinese company that's grande, right? I mean, what do I know? Yeah. I'm not a language expert, but anyhow, one problem is specifically this Evergrande problem and the implications of this, of the ramifications or the ripple effects of it. And the other issue is just specifically what you've been talking about for months now, is the overriding mentality of the Chinese government and how they're dealing and how they're looking and how they're reacting to financial commerce, which is the bigger issue here. And I agree with you. And it's very important. I think it's very important that we separate those two issues because one is a very big, it's like a cloud coming over us very, very slowly. Where the other one is a problem right now. But I think what's happening, Jeff, is I think this Evergrande problem is going to shine more light into the bigger problem, the one you've been talking about. Because I think it's forcing people to say, wow, this is just the beginning of the kind of crap we're going to be seeing from China. So I think this is a wake-up call, if you will. But let's separate the two issues real quick. Let's just talk about the Evergrande problem right now, because I think it's an interesting problem. And yes, I do agree with you. So while it may seem like I'm not agreeing with you, I do agree with you in the long term. I just want to get your perspective, and I just want to get inside. So, but you and I are totally on the same page. This is not we're on the same side here. My question is this: I looked at the balance sheet of Evergrande, all right, and I looked at their global debt. They have $19 billion worth of international debt. Most of their international.
They have a much bigger hole.
Oh yeah. 280, somewhere in the 300. Yeah, it's huge. It's huge. Yeah. But again, international debt. Again, this is why I want to separate the two problems. I'm going somewhere with this. So my point is this: let's just limit our problem. Let's forget about the long-term impact of China. Let's just talk about this Evergrande problem. Okay. Yeah. So the way I'm seeing this particular problem is, worst case scenario, they default. Okay, it's going to be very bad for China, and it's going to be very bad for global economy that relies on Chinese companies for their construction and for the housing market, and it's going to have a domino and a ripple effect. But if you take that and if you look at it in terms of specific damage, not potential, not consequential damage, but specific damage to America. or to the world, you're not really talking about a big financial number. You're seeing this as a beginning of a domino effect.
Again, I'm looking at it as a sign of what's happening with, like, this isn't happening by, like, Evergrande doesn't have a real terrible problem by accident. They have a real terrible problem because they're the largest developer of real estate in China. So what does that mean? It means that China's sucking wind in real estate. What does that mean? It means they're going to be building less. Aluminum is going to be, look at basic material stocks this week, Roger. They might be the worst stocks in the market this week.
Oh,
that's a direct knockoff effect. So Alcoa,
industrial
which is located 4,000 miles away, they're getting whacked in the US because of the fact that there's going to be less demand for steel. There's going to be less demand for aluminum. At the end of the day, you have the inflation side, which is the supply side and the money side, monetary side. But the demand side of the economy is what's suspect right now.
So you're looking at this from you're not even entertaining the short term. You are not really even, basically what I'm hearing is you're not really concerned at all with Evergrande and this specific issue. You're looking at it as a spillover effect.
JP Morgan going to fail because Evergrande defaults on 19 billion? No, like the US banks aren't going to collapse. Asian banks banks might have some serious risk.
Remember, we talked about
exposure. They also have exposure. They also have exposure to real estate in their portfolio too.
Oh, HSBC. Whew.
That's a stock I'm bearish on. So, like how important is Chinese domestic economy to the world? Much less important than the US's domestic economy to the world. Probably a quarter as important.
Maybe even less. Maybe even
less. Maybe 10%.
Yeah, 10%. But
1/10, right?
But it's a big problem. So I agree with you, because my whole point here was, I think that we need to look at this as a bigger problem and not, because everybody's like Evergrande. I'm like, I don't think it's
it's China. Evergrande is like the first of the small dominoes.
It's a symptom.
It's a symptom. But you have to look at who's exposed and who needs Chinese domestic growth. Who's reliant on the Chinese economy, not the Chinese manufacturing economy, the Chinese demand, the Chinese consumption economy is what I'm looking at.
Yeah, no, you're absolutely 100% correct. And I'm glad that we are clearing that up, because a lot of people think that this is a very specific Evergrande problem. No,
I don't even think that's why stocks started really getting whacked this week. I just think the market's been like up 70% in a straight line. And, people are getting nervous. I think people are actually getting much more nervous about the levels we're at, the stuff that you've noticed and you've been like detailing very elegantly and specifically on this program for the last 3 months, the dislocation between the put call ratio, the dislocation between different sectors, including technology, including consumer discretionary. Those things have been symptomatic of a market that looks ready to take a pause, to take a breather, to take a break, to correct. So they use whatever excuse. Evergrande's been a problem for a while, dude. This didn't just happen last night. These guys have been in default for like a year and a half, basically. They've been negotiating for a year and a half. I wrote an article for a big publication about Evergrande, I think in 2019. Like, it's been on the radar for a while.
Yeah, this is definitely not new. And so let's talk about, we already know that there may be some potential longer term implications. I mean, there will be some longer term implications.
For sure.
But let's talk about short term implications, immediate implications on the US stock market. Let's talk about a time frame of a week or two. What are you seeing right now on the horizon?
I mean, it's all Fed now. I mean, the China thing's kind of like winding down a little bit, unless they do something crazy, which they always might.
You never know.
Like they did with the casinos, like they've done, they do these things. They're doing these things for a reason. It's not accidental, but that's the last I'm going to say about that. Fed's going to take over now. So Fed day today, it's the big decision, the big nothing burger on rates, the big nothing burger. I think that everyone is expecting them to bring up their taper schedule and announce that November is going to be when they stop buying $120 billion worth of bonds. Maybe they'll buy 75 or something to that effect, which would be tapering technically. But I'm not sure after what I think they're beholden to the stock market. You and I both know that. They don't care about job creation. They don't care about 2%.
They're so vested in the stock market. It's
8% inflation. We got 6% PPI. Like, these guys don't care about 2% inflation target. They've tripled that. They don't care about the job market. We know that we know that buying mortgage bonds isn't creating any jobs for everybody. My son knows that. He's 8 years old. They care about the stock market. We woke up Monday. We got a big shakeout. It finished pretty nice. It bounced to where it was supposed to bounce. We talked about where it should bounce, the moving average, 100-day moving average. And so I think like your short-term analysis that you gave to a lot of our Wealth Press subscribers and viewers was so spot on. It's going to be a big flush shakeout in the short run. Market stabilizes. We get bullish into the Fed. I think the Fed delivers to the market what it wants to hear. I'm interested to see if the market maintains the positive momentum post the Fed. If the Fed does something crazy, I'm interested to see. I think there'll be a sell-off. If they do announce the taper and they're vehement about it, I think you see a sell-off this afternoon into tomorrow. Maybe rallied back on Friday, but
I think they're going to use China as an excuse. Last time they used COVID, I think they're going to use China as an excuse, and then I think they're just going to do a nothing burger and just going to pass on the buck and say, we'll see how it goes. We're probably going to take action end of this year or beginning of next year, which we already know, which they already said, and it's going to be. I think so. You and I are in the same status quo.
They don't want to stop buying bonds, and
they're looking for
the stock market to have it. They don't want a 10% correction. They are
looking for any reason not to stop buying.
We've had a 5% correction. We're filling that gap a little bit back on the upside, but they don't want a 10-15% correction.
No,
by any means. They'll do whatever it takes not to have it.
Agreed. So I think we're going to hear a lot about China, but I think they're going to be passive.
But I feel like the Fed has been having diminishing returns on the same song. Last time we had a rally and then we gave it right back. Even when they did nothing. So I'm interested
because investors smell it. They know it. I mean, look, we're not going to go to negative. The long bond knows that it's just a matter of time. Okay, so we stick around these levels. There's no reward for going higher for buying bonds.
Yeah, they were supposed to talk about tapering last time. They pushed that off. They used COVID as
Delta. Yeah.
They used Delta as an excuse, and bonds sold off. Rates went higher. They went higher. I think you might get a shock move higher in bonds and rates here at some point.
A fast squeeze out, very possible, and then it'll come down. That happens all the time.
And then it'll reach this like equilibrium a little bit higher than where we are, maybe 20 basis points higher. But I think we could get like 175, something crazy that makes people a little nervous. 30, 40 basis point move.
Wow, you're more bullish than I am in bonds, but you never know. You never
bearish on bonds. I think rates go higher. I think they're artificially low. I think that this is one of the big problems in
yes, definitely. And I think that's
disruptions, why we have bubbles, why.
And I also think that's one of the biggest reasons why the US dollar and the gold market have been very, not uneventful, for lack of a better term.
What people forget, you're right, exactly right. What people forget about what a bond does when you buy a bond as a bond buyer, you should always consider, am I properly being remunerated for the risks that I'm taking in lending this? Because when you're a bond buyer, you're lending money. So am I properly being paid for the risk I'm taking and lending this money out to company X, company B, company Y, the US government,
or the government? Yeah.
Evergrande. And I think for probably about, 5 or 6 years, we have not been properly remunerated for the risks we take in all of these investments. And I think there's a reset coming.
Agreed. I agree with you. Just one more thing I want to touch base with you on, and I've been doing a little research. I've been obsessed with security stocks, cloud stocks, and shoe stocks, sporting goods stocks, and that kind of goes into the gun sales, into shoe stocks. I read something very disturbing yesterday. If you recall, I talked about this with you on this show. I mentioned, and this is a long time ago, like a year ago, I mentioned that a lot of companies are moving from China and into Vietnam because of the restrictions that Trump put on the market during the Trump administration. You remember that. We talked about it. Yeah. And well, I learned yesterday. So I didn't even realize how right I was, but like Dick's, Nike, they moved all their factories there. Yesterday, I read an article saying that Vietnam is having a really, really bad time. They have only a 6% vaccination rate.
Yeah.
So all of this move to Vietnam, which they thought would get rid of their regulatory problems that China was having due to Trump, it helped a lot, but now they have COVID problems. So it's kind of like they're stuck.
Vietnam is not like Vietnam in terms of like doing like human labor arbitrage, which is really what it is.
Yes,
Israel
it is.
can do that because they have like whatever. I don't want to get into I don't want to ruffle any feathers, but they're not China in terms of wealth. They don't have the robust population and the natural resources
or the support system.
Or the support system. They're not, right? So, but they have the ability to make soccer balls, sneakers at cheap labor cost, right? But the problem is that, and I think that long-term we're going to solve it through robotics and through AI. I think AI is going to supplant the human worker in pretty much all manufacturing within the next 10 years. I think it's going to be much quicker than people think within 10 years.
Yep, I agree.
But you have to still get the local population of a lot of these places more robust, having more rights, better healthcare, better everything, more modernized, I guess is the way to put it. Mexico is another place that you've seen a huge manufacturing shift into, and they're not ready either. Mexico, right. But they will be. And I think robotics will help a lot of that. It's going to be a transition. It's a transition.
It is going to be a transition, but I want to warn all our readers to keep an eye on supply chain in sporting goods and sporting shoe stocks, especially ones that are made in that were made in China or put together in China. And keep your eye on Nike, because Nike is a big global brand, and if they can't. Basically, what I'm trying to say is we may see the same issue we're having with cars and chips. We may be seeing it with shoes.
I'm buying Christmas gifts already, dude.
Right.
We're 2 months out from the Christmas we're sitting.
You're a smart man. You're a smart man, because we're going to have, and I've been saying it for a month already, we're going to have some major supply chain issues in Christmas. Folks, what Jeff is doing, he's smart. He's hedging himself. That's very smart.
I'm a trader, man.
Yeah.
Panic before everyone else panics, or don't panic at all.
Folks, we're going to have some supply chain issues during the holidays. Apple Computers already warned us that their iPad chips made by 𝗧𝗴𝗀, which makes them in China, is having problems. Vietnam.
Don't wait for Black Friday. The deal's not. They'll give you the deal, but they won't have the product. You can get it. You get it by Easter.
Right. Well, Jeff, this was a wonderful, wonderful session as usual. And for those of you at home, I think that, again, Jeff and I are both in agreement. We think the market in the short term is going to go a little bit higher, going to bounce from here. But it's a question of what will happen in the coming weeks, because China is a black cloud on our economy, and it's not going away anytime soon. And Jeff is right. Let me just say this, Jeff. Your view that we should be looking at this Evergrande as a change in sentiment, as a view of what's coming, and a view of trying to get inside their head, versus looking at this as the Evergrande problem, is the right way to look at it, and it is the way a professional would look at it. And you're right; it's giving us a real good view of how these people are thinking about business, which is scaring the living crap out of me.
It should, but at the same point in time, like there's to play the devil's advocate against myself, I guess. And this is what you've been saying, and I agree with you. The flow out, there's a lot of investment dollars that flowed out of the United States and flowed into Asia, emerging markets, and China. The flow out, the performance has been like this for the last 10 years. The US has outperformed by 400% over China and emerging market stocks, but we haven't even seen the real flow out of a lot of these stocks and countries like we're going to see in the next 2 years, which is going to create amazing long investment opportunities for North American, not just US, some European. Problem with Europe is they're not really like, they're not really like heavily into electronics and innovation and stuff like Asia is with the US. Right. They have a lot of legacy. They have Louis Vuitton. They have Moet. They have those kind of companies. They have 200-year-old luxury Prada, Ferrari, these kind of things.
I agree.
They don't have a Taiwan Semiconductor. They don't have Qualcomm. So I'm looking at supplanting some of that and creating big investment opportunities for us in the US.
Agreed. Couldn't agree with you more. This is why I love talking to you. We always have some interesting points of view, and I always learn something new when I speak to you. Which is absolutely wonderful. Before I let you go, do you have any ideas? I know I love the pair trades, the link trades. Anything going on there? Anything you want to give us a little taste of something that you got going on, or something you just closed out?
I don't want to give the specifics because the trade is literally
sure,
a day or two old. But I'll give the broader strokes.
That's all we need.
Long U.S. banks, short Hong Kong banks. You can fill in the details.
Oh, absolutely. There's so many.
Because this is the thing, guys. And I remember this very, very personally because I was trading the 2007 and 2008. When we had the Lehman Brothers moment, Bank of America stock and Citibank stock still had 75% more downside 6 months later. So just because something happens doesn't mean that's the end all be all of it. Usually the contagion takes a long time to work itself out. Usually institutions have such massive positions they need to unwind, and things get a lot worse before they get better. So I'm looking at this as a 6 month to a year trade where I think Asian banks are going to be under severe pressure.
Agreed. And folks, by the way, Jeff and I have talked about the specific banks many, many times on this show. So if you guys want, look back at our previous sessions, go back a year, and you'll see that Jeff and I were talking about exactly the same topics that we're talking about right now. And Jeff was telling us that this is coming. It's coming, and it's here.
Thank you.
Again, notice how he's not focused on Evergrande. He's focused on the bigger picture and the impact of this change in the mind of China that'll have on the economy and the ripple effects thereof.
And I think October, and we've been discussing this, we'll be back next week, but I think October, I think you need to get active trading. You need, like, if a 2% correction, which is not even a correction, it's a garden variety sell-off. If 2% makes you a little bit nervous, you're probably too exposed to stocks because you're going to get a few more of those kind of bumps in the next 45 trading days.
Agreed. Jeff, this was a wonderful, wonderful session. I appreciate your time as always. Folks at home, if you want to check out Jeff's, and this is really a great time to follow Jeff because Jeff hedges himself with his link trades where it's a pair trade, where volatility is what you're looking for, not market direction. And he's just got this global markets wired like the back of his hand. Really, he is our expert on China, and I highly recommend right now you pay attention to what he's saying because he is hot and he's got the rhythm of what's going on in his mind. And whenever somebody has the rhythm of what's happening in the market, they can usually see what's coming up and play it like a game of chess. And that's what Jeff has right now. So you definitely
likewise. We get it together. It's a collaboration. It's the teamwork, honestly.
Well, thank you. I appreciate you saying that.
People should understand that this is not a solitary sport. Trading is a team sport, and that's what we're here. That's why Roger and I do this, really. It's why we're here. I didn't mean to interrupt you, Roger.
No, it's all good.
It's really why we're here. We're here because we get better through collaboration with each other, and we support each other. And we correct each other when we're wrong. We show a different perspective when we might need a different perspective. And most importantly, we give like broad strokes on how to protect yourself, protect your capital, your portfolio, your psychology. And you can only get that through a team. You can't be solitary in this game.
Could not have said it better. Folks, if you want to see what Jeff has in store, what stocks he's playing, what he's looking at, go to 𝗧𝗴𝗀𝗀.com, 𝗧𝗴𝗀𝗀.com. Simple, easy, clean, just like Jeff's trading advice and signals and his picks. And if you want to reach out to Jeff, simple, jeff@𝗧𝗴𝗀𝗀.com. And you can also find all of Jeff's services on the Wealth Press page as well. If you want to reach out to me, support@marketgeeks.com. Jeff, this was a wonderful, wonderful session. Stay out of trouble, lower your exposure. I'm going to do the same. And I will check in with you next week.
Fight with both hands.
Definitely. This is a fighter's market.
This is a fighter's market. All right.
Bye, Jeff.
LFG. See you guys.
Bye.